What if I told you that a trader that's wrong 60% of the time can make more money than someone who's right 60% of the time? Here's the brutal truth. Most traders focus obsessively on being right, but they're completely missing the math that determines if they're going to be profitable. There's a simple equation that every profitable trader uses, even if they realize it or not. And once you understand this formula, you'll understand why sometimes traders that have worse strategies actually outperform those with better strategies. In the next few minutes, I'm going to show you this equation, walk through real examples of how it works, and give you probability frameworks that you can use to stay profitable, even when you're wrong. Let's dive in. Okay, so the most important part of this formula is that you understand your profit has to be more than your losses. So this little tiny formula seems really simple and obvious, but the most important part of this formula is this little guy right here, the greater than sign. It is very, very important. You have to make sure that your profits are greater than and not equal to and not less than your losses. And again, I know that seems very obvious, but let me explain. If we had to describe profit, we could describe it as the probability, and that's right here, the probability that your trade will go in your direction, or your win probability is kind of what I'm calling it here. And multiply that times your take profit right here, which you set as the area that you believe you're going to take profit. And when we define loss, it's basically the same thing, but the opposite. So our percentage or our probability that the trade is going to go against us, which is the probability of it being a loss. And to further define that, we could say right here, that is 100% minus whatever you thought your win rate was, or what your win probability was. So if you thought this was a 60% chance of winning, then that inherently means it's a 40% chance that it could lose. And you're going to multiply that times your stop loss. And it's very important, guys, that the take profit and the stop loss is set before you enter the trade. So when we put that whole formula together, we get this formula here. We get the percentage that it's going to be a win times the take profit, and that needs to be greater than the percentage that it's going to lose, or not the percentage, I'm saying the wrong word, probability. So probability that it's going to win times your take profit needs to be greater than the probability that it's going to lose times your stop loss. So let's look at an example. Let's say that you believe the probability that this trade is going to go in your favor is 60%. So this is a trade that you feel pretty good about. You're 60% sure it's going to go in your favor. And let's say that your take profit is set already, and it's set right here at 20 points, let's call it. Then on the other side of the equation, we're going to take 100 minus the 60 that we already figured out, which was over here. And that's going to end up being 40. And we're going to multiply that times our stop loss. And let's say that our stop loss is 10 points right there. So on the profit side, we get 12. And on the loss side, we get 4. Now, 12 is greater than 4, and it's actually considerably greater than 4. So this is a really good trade. The trader's equation tells us that we should take this trade. But just because this one worked, I want you to keep in mind that this equation is flexible. So while a 60% win rate with a 2-to-1 risk to reward is definitely profitable, there are lots of other ways to make this equation profitable. You can have all sorts of different scenarios. You can be the kind of trader that only takes really high probability trades. You can be the kind of trader that takes low probability trades but has a high risk to reward. There are many ways to make this equation work. You have to figure out how it works best for you. It's just important that the profit is somehow greater than the loss, no matter what numbers you use to get to that place. But we must stick to that take profit and that stop loss that we set whenever we're doing all of these calculations. And we must stick with it throughout the trade. So you can't make a calculation or make a determination according to this equation and then enter the trade and then start changing your mind, like start lowering that stop loss because you think, oh, it's gonna turn around at any point. If you start doing that, you're gonna make the equation go in the opposite direction, and it's not gonna be profitable for you any longer. The other trick is that you need to know the probability of this trade. Like, how good of a chance is it that this trade is going to work out for you? And especially in the beginning, that's really hard to know. I don't think that's something that people intuitively know. One of the things that I have done to try to get better at this, to try to know what chance a trade has of if it's going to work or not, is as I am making my trades and journaling my trades, I am writing down before I enter what chance I think this trade is. So if I'm feeling really confident about a trade and I say like, oh yeah, I really think this is a good thing because all of these different points line up, I'm going to say that's a 60% probability. And I'll write that down so that way I know. And then if I'm entering a trade and I'm really kind of like, I don't know, maybe it'll work, maybe it won't work, then that's going to be a 50% trade. If I'm entering a trade and I'm saying like, oh man, I don't know, this is really like, I don't know if this is going to work at all, but if it did work, it would be really cool. Then that's going to be a lower, like maybe a 40%. And if you keep tracking and journaling this probability that you're estimating, I think you'll get better at your estimation as time goes on. But in addition to practicing the estimation part, I can also give you a few hints and a few tips about general probabilities. So for example, these are some trades that have really good chances of working. They have a 60% chance of winning. So these are the type of trades that in order for the trader's equation to work with, you need to at least have a 1-to-1 risk to reward or better. So you need your reward to be at least equal to or greater than your risk. So here are some of these types of trades. The first one is whenever you are in a trend and you take a second entry off of the trend line. So we are in this downward trend down here, and I see my first entry because we seem to be bouncing off of that trend line and pivoting downward. But if I don't take that first entry, I take the second entry, which is like the second setup that I see where we're bouncing off of this trend line or moving away from this trend line. Then that would be a second entry, and those have a really good probability of working out. Another type of trade that has a good chance of working out is if you are entering at the tops or the bottoms of a trading range. If you see like a pivot at the top of the trading range and it looks like we're heading down the trading range, that's a good place to enter. Same thing with the bottom of the trading range. If you see a good signal bar right there and you think we are pivoting to go back up in the top of the trading range, then that's another good place to enter. And finally, if you see a breakout that happens and then there's some consolidation and then we pull back up to test that breakout line, when you start to see that the pullback is continuing to go in the direction of the breakout, then that is a good place to enter and that has a pretty good chance of working out. Here are a few types of trades that have more of a 50-50 chance of winning. Sometimes they will work and sometimes they won't. In this case, you want to have a risk to reward ratio of at least 1.5 to 2. So you want your reward to be at least half larger than your risk. So one example is if you're in a tight trading range and you're expecting a breakout to happen on either side of the trading range. And the reason why this works is because your stop loss, since it's a tight trading range, your stop loss doesn't have to be very big. But if it does work out for you, then it's going to have a really big reward. Another example is that you're in a trading range, and this one's kind of a little more of a very slow sloping trend, but imagine it's a trading range. It's almost the same thing. You're in a trading range and you are expecting a reversal and you're expecting to go back up or down in that trading range. So like, for example, in this one, we have a double bottom with a new high, and there's a pretty good chance that we're going to continue up to the top of that trading range. So for these examples, let me show you why these work. And these work because of how we can manage our stop loss and our take profit. So in this first example, where we have a tight trading range, like I said, your stop doesn't have to be that far from your entry, but your potential profit can be very far from your entry. So in this example, we have a 2.15 risk to reward ratio. So we have more than double a reward to our risk, and that would be a good trade. On the second one, because we have that bottom line of that trading range, we can use that bottom line as our stop loss, and we can use it as a pretty safety barrier. We don't have to worry about going below it, or at least we know that if we go below that line, we want to exit this trade anyways because it's probably not going the way that we think it's going. So if we put our stop loss right there, like maybe one tick below that bottom trend line, and then that gives us the potential for a really big reward if we put our take profit at the top of the trading range. And in this example, it's a 2.18 reward to risk ratio. And so those would both fall well within our 1.5 to 1 risk to reward ratio. Now, what about some trades that have a 40% chance of winning? If those trades need a 2-to-1 reward to risk ratio at least. So here's an example of something that would be a 40% chance. If you have a low in a bear trend and you think that we're going to pivot at this new low, then you can enter here. So in this example, because we just had this low over here where we had wicked down, we have a good place to use as our low threshold. And we're just going to this one is just kind of really guessing, like maybe we're going to turn here. So I would put a really, really small stop loss, because if it doesn't go in that direction, you want to quickly exit out of it. But if it does go in that direction, then you can catch something really big. And there are some trades that have a 40 to 60% chance of winning. So we're not really sure. It could go either way. It's kind of got a big window of probability. So for these trades, because that window is so large, you really want to try to be at least at a 2-to-1 risk to reward ratio. One example of that type of trade would be entering at a breakout test with a limit order. And another example would be if you were expecting a bounce on a support or resistance line and you entered there. And here you can see where we entered our stop loss. Because we were retesting that breakout, we set our stop loss. You can see over here, if I was just making a guess that we might be bouncing off of a previous support, because that doesn't happen all the time, that's definitely more of a 40% chance, I would want my stop loss to be very small, because if it's not going to work and if we're going to go through that support line, then I want to get out pretty quickly. But you can see that sometimes these have really big rewards. Like this previous support bounce had a risk reward ratio of 7.68, and then we didn't even catch it all. Like we could have had it be even higher, but I probably would have set my take profit around here, because whenever I look at this previous high that we had, I would kind of expect us to go at least up to here. But just in general, if you were unsure about a trade whenever you enter it, that might be a 50% probability trade. But if you feel confident whenever you're entering a trade, like if you have several different setup points that are lining up and you feel like this is a good trade, then you're probably closer to the 60% mark. Maybe 55, maybe 56. You can start playing with that as you estimate this. But remember, and this is super important, even the best professional top echelon of traders don't have win rates that are higher than about 70%. So don't go into a trade thinking it's 100% or even a 90%. There's just no way that's happening. For most of us normal humans, I think 60% is a top. It's like a good upper threshold for our probabilities. But the good news is that if you are using the trader's equation consistently, if you were sticking to your take profits and your stop losses, and if you were calculating those ahead of time, if you were doing that for every single trade, then it doesn't matter. You don't have to be some kind of amazing genius trader. You can still be profitable even with 50-50 trades if you stick to the equation. So let's look at one example. So I've got Trader Sam here. Over the course of trading 100 trades, he has a win rate of only 40%. So he's not perfect. But every time that or at least we could say his average risk to reward ratio is that on average, whenever he wins 200 points, or for every 200 points that he wins, he risks 100 points. Let's say, I mean, those are a lot of points. But anyways, let's just use this as a very simplified example. So in that scenario, Trader Sam has an equation of 80 points, which is more than, he has an equation of 80, which is greater than 60. And if you add all of that up for the 200 trades, he would profit 2,000 points. So that is pretty good, even if you only have a 40% win rate. However, Trader Joe over here, he has a win rate of 60%, and he thinks that he is hot stuff. He thinks that he's really good at this. But the problem is that when he wins 100 points, he's risking 150 points at the same time. So when he loses bigger than he wins, even though he's winning more. And if you do the equation here, it ends up being equal. 60 is equal to 60. So that means that at the end of the day, he has zero profit. So I don't know about you, but I would rather be wrong sometimes or wrong a lot of the time and still have a profit. Consistently sticking to your trader's equation can make you a winner even if your strategy isn't the best. And this is why sometimes you will see people trade who are not exactly the best traders. They don't make the best decisions, but it's okay. They end up still profiting a lot because they have a really good trader's equation, or they are sticking to that math, and they're not afraid to set their stop loss and set their take profit and stick to it. Thanks for watching. I hope this video was helpful to someone out there, and I'll see you next time.